what the examiner was required is, with suitable calculations, explain the accounting treatment of the various items of the defined benefit scheme on the financial statement of Kibo Limited for the year which ended 31st December 2021 in accordance with the IAS 19, which governs the employees benefit, So what was required here is, using suitable calculations, we explain some of the accounting treatment, or basically the accounting treatment of various items in the financial statement of Kibo Limited. So this is part B of the question, which was requiring we explain treatment of various items in financial statements of Kibo Limited, Limited. Now in this case we have a number of items which are supposed to be determined and accounted for in the financial statement of Kibo Limited. Essentially there are three items. Which are those items? One, we have something called the net pension cost, net pension cost, of which this net pension cost, this is supposed to be taken to the income statement as an expense. So the first item here is the net pension cost, And the other one is something known as the net actuarial, gain or loss. And number three is what we refer as the net defined benefit. We can just refer to this as net defined benefit, asset or liability. So these are the three items now which now a company which is operating a defined benefit scheme should be able to compute and basically account for in the financial statement at the end of the year. Now first of all, this net pension cost, this one is accounted for as an expense. This one is accounted for as an expense in the income statement, whereas this net actuarial gain or loss, this one is accounted for as part of other comprehensive income. Remember here, when talk about other comprehensive income, we are talking of other items of incomes or expenses, or items of incomes or expenses which should not be included as part of the profit or loss for the year. And then this net defined benefit asset or liability, this one should be accounted for in the statement of financial position as an asset. If the company has determined this and the company has gotten the net defined benefit asset, this one is accounted for as a non-current asset, whereas a net defined benefit, we have said this should be non-current asset, whereas a net defined benefit liability is accounted for as a non-current liability in the statement of financial position. So therefore, what we need to do, or what the examiner was requiring as far as that question is concerned, is you compute these three items and basically you also explain how they were supposed to be accounted for in the financial statement of Kibo Limited. So therefore, let's compute these three items, and I think we can start with the second one here, that is the net actuarial gain. After computing that, then we proceed. We compute the net pension cost and then the net defined benefit asset or liability. So let's start by determining this. We can just refer to it as, yes, we refer to this as net actuarial gain or loss. net actuarial gain or loss. Now, how do we determine this particular net actuarial gain or loss? To determine this net actuarial gain or loss, there is the formula or the approach now which we use to compute this one. That is what you are supposed to remember. So to compute this one, remember our figures there are given in what? Are given in million of shillings. So we need to have a single column here, a single column. And what we start with here is what is known as the net defined benefit obligation, balance brought down. So in this case, when talk about the net defined benefit obligation balance brought down, this is the opening balance, or basically what you're given there as the net defined benefit obligation on 1st January 2021, which is given as 1850. As 18 what? 50. Now to this, what do we add? To this we add something called the net interest cost. The net interest cost. Now this particular net interest cost we computed based on the rate which you are given there. If you go back to the question, the last paragraph there, we are told the high or the market yield of high quality corporate bond is at the rate of 5%. So in this case we take 5% of the net defined benefit obligation at the start. So we take 5% of 1850. So we get 85%. That is 5% of our net defined benefit obligation at the start. So 0.05 times 1850. So which will give us 92.5. 92 point what? 5. And then to this, what do we add? To this, then we add what we refer as the service cost, or what in other terms we refer to as the current service cost. The current service cost. The current service cost in our case here given that is an amount of 200 million. And then to this, after adding those two items, what we less here, sorry, not we less. Yes, so what are we given there? We are given the contribution to the scheme. So we need to take into account that here, the contribution to the scheme, of which this contribution to the scheme, automatically this one should be what? Should be deducted. How much is that? Is 225. 225. Now what you need to note here is that if you're using this particular approach here of computing the actuarial gain or loss, whereby we are using the net defined benefit obligation. Remember, the net defined benefit obligation is the net amount of what we refer as the plan asset and the plan obligation. So if you're using this particular approach to determine the net actuarial gain or loss, we don't less the benefit paid here, because the benefit paid are deducted from both the plan asset and the plan liability. So that one should not be deducted here. But if we were to use now the other approach, whereby we compute the actuarial gain or loss in respect to a plan asset separately, and the actuarial gain or loss in respect to the plan obligation separately, remember we have to deduct the benefit paid. But when using this particular approach here, I've said we don't less. We don't do what? We don't less those benefits are paid. The benefits paid are not supposed to be what? To be deducted there. Are not supposed to be deducted there. Then what we need to do is to get what we refer as the expected net defined benefit obligation at the end of the year. So we take 1850 plus 92.5 plus 200, that is minus 225, and that will give us a 17.5. Then what we need to do to this is we need to compare it. We need to compare this with the net defined benefit obligation at the end of the year. and this is the amount which you're given as 2,000. So basically we need to compare these two, and remember that a net defined benefit obligation is essentially a liability. So basically what this means is that the company expected that the defined benefit obligation, the net defined benefit obligation, to be 1970. This is expected. The expected net defined benefit obligation, but you can see based on the actuarial valuation which was done at the end of the year, the net defined benefit obligation at the end of the year was determined to be what? 2,000. So basically we can say that there is an increase here in the value of liability. How much is our increase? We get the difference. The difference here is 82.5. 82.5, and because this is an increase, and also we have said that this is a liability, anytime the value of a liability increases, then that automatically is a loss. But in this case, remember, we are going to refer to this as what? As the net actuarial. The net actuarial, we have said this is an increase, and basically take into account this is a liability. This therefore will be what? Will be a loss, because anytime the value of a liability has increased, automatically that is what? Is a loss. Now this particular loss, or this net actuarial loss, is what you have said was supposed to be accounted for as part of other comprehensive income. So therefore we can go ahead and basically we give that particular explanation, because that's what the examiner was requiring. We say that the net actuarial loss, the net actuarial loss of shillings 82.5 million was supposed to be accounted for, or supposed to be accounted for as part of other comprehensive income, what? Income. So that is the explanation which was required here, that the net actuarial loss, this figure which you have computed here of 82.5 million was supposed to be accounted for. This one was supposed to be accounted for as part of other comprehensive what? Income. Remember, you have said that the other comprehensive income, these are basically other items of incomes or expenses which should not be part of the profit, or these are incomes or expenses for the year which should not be part of what? The profit or loss for the year. Now, having determined that, we can proceed and we determine this net pension cost. Net pension cost. Now, how do we determine this particular net pension cost? How do we determine this net pension cost? So to compute this particular amount of net pension cost, equally we take a number of items here. We take a number of items. One, we take this net pension cost. This net pension cost, net pension cost, how much is that? That is an amount of 92.5. This is an item of expense. We also add the current service cost. Current service cost. How much is that? Is 200. And basically these are the only two items now which we take into account. But remember, when computing this net pension cost, in the event you are given the plan asset and the plan obligation separately, here you ordinarily have more items, because like in this you should be having something called the interest cost and something called the expected return on plan asset. Now this net pension cost is a net amount of those two items, interest cost and the expected return on plan what? Asset. Then you should have the current service cost. Already we have that. The past service cost, in our question we don't have the past service cost, because there was no improvement which was done by this company. The company has not increased those pension to be paid to the employees in what? In the future. Essentially, there we should have around 4 items. I've said we don't have the per service cost, and then I've said that the net pension cost take into account the two costs, take into account the two items, interest cost and the expected return on plan asset. So therefore, the net amount here, which is 292.5, this was supposed to be accounted for as an expense in the income what? Statement. So therefore, we can give that explanation here. The net pension cost, the net pension cost was supposed to be accounted for, was supposed to be accounted for as an expense, and specifically this net pension cost, because this is an employees related expense, it is accounted for as administrative expense in the income statement. Supposed to be accounted for as an expense in the income statement or statement of a profit or loss. Statement of profit or what? Or loss. Statement of profit or loss. So therefore, that is the explanation which was required there. You explain that net pension cost of basically 292.5 million, this one was supposed to be accounted for as what? As an expense, specifically administrative expense in the statement of what? A profit or loss. Finally, what we need to do is we compute the third item here, the net defined benefit asset or what? Liability. This is quite straightforward because the two items to be used here are given there. So let's compute that. The net defined benefit, asset or liability, benefit asset or liability, So how do we compute this? So to compute this one is quite simple and straightforward. Yes, so here we need to take into account only a single item which is already provided for us in this question, and that is now the net defined benefit obligation. Now this net defined benefit obligation at the end of the year is what was supposed to be taken to the statement of financial position of this company, and because it's a net obligation, obligation, that amount was supposed to be accounted for as what? As a non-current liability. And how much amount is that? The amount there is 200 million. Now that is 2,000 million. Now this 2,000 million was supposed to be accounted for by the company as what? As a component of non-current liabilities. As a component of non-current what? Liabilities. So I think we can equally give that explanation here. We can give this explanation here, and we say that the net defined benefit liability, net defined benefit liability at year end is a non-current liability, non-current liability in the statement of financial what? Position, is a non-current liability in the statement of financial position. So therefore this was supposed to be accounted for, or basically to be taken to the company statement of financial position as an item of what? Non-current liability, as an item of non-current what? Liability.